Hello everybody and welcome to a new episode of Crypto in 5, where we discuss important and interesting crypto things in just 5 minutes. It's sponsored by Global Crypto Research. Today we'll discuss 6 key factors to select a successful cryptocurrency. So in this video, 6 key factors will help you determine whether a crypto coin or crypto project is unique and stands out, or if it has no added value and you should avoid buying them. First, an important key factor to select is the function. Whether you invest in crypto stocks or in crypto coins, the purpose of the company or the project is almost the most important aspect. Therefore, always ask yourself which problem an application solves. There should not always have to be very persistent existing problems for an application to become successful. On the contrary, a whole new application can also be created. Ethereum is a great example of this. The function of a crypto application is about new capabilities or existing capabilities and can be a lot more efficient and or at a lower cost. So also ask yourself, what's the target market of this application? The bigger the piece of the pie target market, the more value it can create for investors. So for example, the difference between Bitcoin and Ethereum. Bitcoin is an independent, scarce digital currency that allows you to send, receive, or store value. Ethereum is an independent digital economy. Probably the piece of the pie is bigger with Ethereum than with Bitcoin. A second key factor is the purpose of the token. A token is where you invest in. It's important that the success of the function of the crypto application ultimately translates to a higher price of the token. The important question you will need to ask yourself is, will the token absorb value from the application's success? In the crypto market, tokens have different functions. For example, some tokens must be used in an application for you to be able to use the application. Ethereum is another great example of this. Every day, tens of millions of dollars of Ether are used to use the smart contracts in the network. Another example is Uniswap, perhaps the most successful application within the Ethereum network. Uniswap allows you to trade through Ethereum without having to rely on an intermediary like a broker. This functionality is extremely successful, only it doesn't affect the Uni's price. This is because you don't need Uni to use Uniswap. The token only provides you with voting rights over the application, so no value is created. The third key part is the copy resistance. Copy resistance is the most underexposed key factor, in our opinion. A lesson from capitalism: excessive profits are outcompeted. When something is hugely successful, competition will arise to take advantage of the success. This leads to more similar applications in the market, and the same pie has to be divided among more players, leaving a smaller piece for everyone. But what if an application cannot simply be copied? Then the pie will not only be divided, or at least much less, you will be left with a bigger market share. A network consisting of hundreds of thousands of computers such as Bitcoin is almost impossible to copy. As of today, there are no blockchains that can compete in decentralization with Bitcoin. There are, however, many blockchains that compete with each other on performance, the speed and amount of transactions per second. To set up such performance blockchains, dozens of computers are enough. That's relatively easy compared to a network that excels at decentralization. Then we move on to the team. It might look as good as humanly possible on paper. At the end of the day, the team is responsible to realize the potential. Most of the time, you won't be able to talk to the team and make conclusions on them. So how can you assess a team? Investigate the background of the team members. A positive sign would be if team already has experience in other successful crypto projects. That would decrease the possibilities of rookie mistakes. In addition, check how team members behave in community chats, such as Telegram or Discord. If they can be found there a lot and are actively answering questions, they are probably totally obsessed with the project. This can also be a great opportunity to ask sharp questions to the team. Then we have the network effect. A famous investor once told me, in the digital spheres, nothing is more important than network effects. The law of the network effect states the bigger a network, the more value a network gives to a user, and the more likely it's to grow faster than the rest, or maintain its dominant position. The network effect is especially important in the digital world because, as an internet user, you have instant access to every piece of information. It's just a matter of typing a domain name into your URL bar. In the physical world, you are rather limited by geographical locations and therefore will not always choose the best efficient provider. Some great examples of a dominant network in crypto are Bitcoin, Ethereum, of course, the two biggest crypto coins. Those who want to settle a transaction at a relatively low cost with a high security will 99% of the time choose Bitcoin or Ethereum and not any alternative payment network like Litecoin or XRP. And the last one, tokenomics. The price is always determined by supply and demand. Demand is determined by all the key factors above. Supply is largely determined by all the tokens yet to enter into circulation. This analysis is important in crypto because each crypto has its own inflationary trajectory. The lower the inflation, the better. Bitcoin is the best example. The most important factor of Bitcoin's success is the limited number of Bitcoins that can ever enter into circulation and ever-decreasing issuance of these Bitcoins. The limited supply and ever-decreasing issuance makes Bitcoin scarce. On the other hand, you have much smaller and younger crypto applications, where only a small portion of the tokens are in circulation. If 90% of all tokens that ever become available are yet to be issued, that's an additional risk. Suppose there's not a lot of demand in the market at the time of issuance, that could weigh very heavily on the price. You can check this information via CoinGecko. This usually shows the circulation supply and the maximum supply. The difference between these two is future inflation. So, when you have these 6 key factors that determine a successful currency, you can make a lot of money in the crypto market. You can also check out the reports at Global Crypto Research, where we discuss crypto coins and crypto stocks. We select the best for you in a mouse click. Just check them out at our website, globalcryptoresearch.com. Thank you for joining this video.